Hey, Chris, thank you so much for joining me today. I'm pumped.
I'm excited to be here. It's something I've been thinking about for a while. I hear a lot about you, and I'm excited to talk real estate with you.
Same thing. Let's start and give the listeners a little bit about your background and kind of what you're up to these days.
Well, yeah, absolutely. So, I've been in the real estate business pretty much my whole life. I like to kid my father that if it wasn't for him, we wouldn't have the Housewives of Orange County, because his first job was in real estate was president of Coto de Casa. And he did the water deal and the deal from the freeway that allowed it to be all built. And so he took something that was Coto de Casa was Portuguese for the land of the hunt. And now it's all asphalt and McMansions. And so I blame my father for all of that. But I've been in the business a long time. I watched him and his partners. He was partners with Rob McGuire and Jim Thomas. And if you saw the movie with Will Smith, Independence Day, they blew up U.S. Bank Tower, and that's a building that they built together. And then he was at Catellus, which was a largest landowner in California, major REIT that when he took over was like a $400 million market cap, and they sold it for $5.8 billion. And along the way, not only did Prologis get all the industrial assets, but if you go to a Warrior game in Mission Bay in San Francisco, you'll see his imprint there and where UCSF is. And so I kind of grew up in this business. Of course, went through the stages of there's no way I was going to be in it. Had grand plans on being an actor that lasted about an audition or two, and said that's probably not for me. And I went to law school, and out of law school, remember telling my dad my first day working at Pillsbury, Madison and Sutro law firm in real estate, saying, "Dad, if being a lawyer is anything like being in law school, this isn't going to be for me." And he's like, "Oh no, I did it for 2 years, and it'll be great." I called him at the end of the first day and said, "Dad, this is exactly like being in law school. They stuck me in a room, told me to read a purchase and sale agreement, and nobody talked to me." So I quickly said, being a lawyer isn't for me. And I did a right turn and had the real awesome experience in the late 90s of working for a gentleman named John Cushman. And John was the grandson and the grandnephew of the Cushman in Wakefield. He had been there up through 68, 69. Came out to LA to lease Arco Plaza. He got into a fight with them in the late 70s and started Cushman Realty, which is a firm he grew to about 11 offices, 100 brokers throughout the country. And I got the job that he'd had about 4 or 5 people do in the past, which was kind of be his chief of staff. And so from the late 90s until 2003, I got to see every real estate deal you could possibly see, from debt, placing debt, to foreclosures, to major lease deals. It was an unbelievable experience, one I could only have done single, because, the first day I started with him, he called me and said, "Meet me at Van Nuys Airport at 7 in the morning. We're flying to Dallas. We're going to negotiate the headquarters lease for La Quinta Inns. I'm on the board there. They've given me the leasing, the brokerage on it." And we literally sat there for 3 weeks and negotiated. I didn't get to come home. And there's some at Las Colinas, which I'm sure you're quite familiar with. We were going to take the top 2 floors at Las Colinas, and we get to, it's like 10 o'clock at night, and John had this view: you stay, and you get this done. And he just kind of lost his temper, and he said, "We're done." We walked out, and this is like 2 weeks worth of work. He's like, "Don't worry, I'll call Opus. We'll move them just down the street." And then within a week, we did a lease. So that was my kind of introduction into the difference between just doing real estate and being, a hustler to get things done. But anyway, so I did that. And in 2003, said, I can't be a broker anymore. I want to be a principal. Started my company in 2003. Started on a really interesting idea. We had represented Oscar De La Hoya when I was with John. And I just said, "Hey, Oscar," I went and saw Oscar's person, Richard Schaefer, and said, "I'd like to have this meeting with you. I'm leaving Cushman. I have this great idea. Why isn't there, I see these Magic Johnson movie theaters. Why isn't there a Golden Boy theater?" And Richard said, "That's a great idea. So what are we going to do?" And I'm like, "Oh, I didn't know you were going to think it was a great idea. Let me come back." And he's like, "Well, Chris, Oscar would really like to own an office building in downtown LA. Is that something you could do?" I was like, "That might be something I might be able to do." And I literally left, ran into a broker I'd known for a lot of years, and he said, "I have an idea." And that idea started with me saying, "Oscar, I found the building. Let me take my commission, roll it in as equity, and I'll operate the property and I'll lease it. And that started me in the principal business. And then several years later, my father, after he sold Catellus, we decided to merge together, and we formed Rising Realty Partners, which has been around since 2011. And I think we've raised well over $5 billion. We own about 5 million square feet. And but now I'm finding ourselves kind of making a little pivot. We're moving, not that we don't believe in office. I want to talk about that. I really do believe in office, but we had already planned to be an industrial. We had already planned to be a multifamily. COVID hit, and we just pushed through. And so now we're buying an industrial deal in Vegas. We're buying a multifamily deal. So we're trying to take that 5 million square feet that's mostly office with some industrial into a broader platform of office, industrial, a multifamily. And we do own a big data center, which has been a hell of an education. So I noticed I didn't stop talking, which is because usually I'm the interviewer on my podcast. So I guess I took advantage. But hopefully I gave you and the audience a little framework for some of the things that we do here at Rising.
100%. I want to dig into a few of those before we get into Rising. But with Cushman and being early on, so you left in 2003. It was at 100 brokers. Was he always teeing it up to be this huge company that it became? And was that always the plan, or did that just kind of happen like by happenstance? And were you involved in any of that?
Well, here's what I'd say about John. I've never met a guy who worked harder than John Cushman. My father works hard, but John's like a whole nother level of working hard. Now, I'll kid with him a lot and say, you win 150%, but you were like 78% effective here, John. Yeah. I mean, you burned a lot of bridges and you did a lot. But so for John, he always thought he would be the CEO of Cushman & Wakefield. And when they moved him out to lease what was then Bank of America Plaza and the Arco buildings, it was a huge statement. And then about 10 years later, they said, okay, John, it's time for you to come back. He got into a disagreement, and I think he started the company on April Fool's Day in 1978 in a huff. And he started to build it up, and you could always tell that his goal ultimately was to come back to Cushman & Wakefield. That happened to, I worked on it with him. Another guy who was his CFO was really the architect of the merger acquisition. And then John really led C&W along with a couple other people, a guy who I went to Duke with and a few others up until the GFC. And then the company started changing. John's still working. I talked to him a lot. He's still calling boards and trying to get leasing assignments and trying to make deals happen. But he's now 80, and he's still moving, but it's a different pace.
Yep, that's an awesome experience. All right, so you start Rising Realty Partners. Is it a principal firm, or do you do any third party work for others, or is it all for your own account?
Well, we do third party property management and third party construction management. One of the things that I learned early on in my business. When I bought that first building with Oscar de la Hoya, at the very end, I had lined up Grubb & Ellis to be the property manager and white label it for me. But as a broker and as a lawyer, I was really scared of property management. Like, I didn't know what to do. And so we get right near the end, and the person we were buying it from was a guy named Michael Barker, who also comes out of Texas, but Barker Pacific Group. He had bought it a year earlier with a hedge fund. I'll think of it in a second. A very well-known hedge fund, but they had bought it because someone had in the early 2000s had taken out an elevator, and they were making this big telecom play because it was right next to one Wilshire. So Michael's like, "Hey, Chris, I'm really glad that you guys are buying it." He should, because he bought it for 8 and we were buying it for 15 with less than a year later. So it's now worth like about 60. So we're all good. But we were doubling his money. And he goes, I just built out my office, and, you have a leasing background. Why don't we do this? I'll do the proper, I'll roll in my money. So I'll be 6%. You can be 1%, and Oscar will be the other 93. And I'll do the property management, you do the leasing. So that's great. When we bought the building, it was about 48% leased. Over the next few years, I got it to 92% leased, where it's kind of stayed. And I was like, this is great. But then I got to 92, and Michael's getting a check every month. And he has every month since we bought it in 2003. So I learned early on, you really want to have a platform that has reoccurring revenue. And so ever since then, I never give up the property management. The key is you got to hire great people. And then once you have the great people, you go, if they can do it for our account, we should do it for others. And so Casey Hawk, who's a woman who runs our property management man, we just see the world the same way on ESG. We have a statement that impact is alpha. That when you put impact strategies into an office or an industrial or multifamily, you're creating alpha, because most people are like, no, what does solar panels really do? I think maybe COVID has gotten us over that, but for the last 10 years, we've been fighting that battle. And then people go, why are your operating expenses less? Why is your retention better? And it's because we really believe that the property manager who has our card cares about this property more than somebody who's CB or JLL. Nothing against those companies, but their bonus isn't tied to the overall success of the company, tied to the overall success of the building, maybe. So I think property management is a really important differentiator when you're trying to make people money, whether it's third party or not. So we'd love to grow it even further, and we're experimenting with SEOs and Twitter and anything we can to get the word out. But it's hard to compete, and I'm sure you found this, against those JLLs and CNWs and CBs, and to try to get third-party business. But
yeah, it's funny you mentioned that. We brought in property management. My whole thing always was, let's get the company to scale to where when we started property management, it was actually a profitable business and it wasn't some type of loss leader. And so we've been in it now almost 2 years, and it's been one of the biggest game changers. And it's shocking to me that there isn't like a national brand for commercial management. The biggest companies are like CB or JLL, so they have big property management platforms, but there's no brand name in the industry. And who knows, maybe you'll create that or somebody, but it has been so critical. And you mentioned something that I wanted to get to later, but you kind of already brought it up. What is impact investing to you in kind of ESG? What are you like? How do you define that for somebody that's listening?
No, it's a really good question. It's also one that I get a lot. Let me start with a sad tale. On March 3rd of 2020, I was not March 13th. I was at the New York Stock Exchange. I was talking to a group of investors and announcing that we had signed a letter of intent, and we were going to, in the next day or two, sign the documents on a $750 million office-focused ESG impact fund. And we had a lead investor for $50 million who was going to bring in 700 of their investors, because I don't want to name the private equity group, but they were going to bring in, and everything was great. And so I was explaining what we felt impact was. And for us, impact has several things, but at the end of the day, it's about creating alpha. It's about creating higher returns. So for us, we focus on carbon reduction, number one, first and foremost. The greatest emitters of carbon across the globe are commercial buildings, whether they're office or strip retail or whatever they are. They produce more carbon, and it's really unchecked because most people have no idea what their carbon footprint is if they own a building. So we really focus on carbon reduction, number one. We partner with people like Carbon Lighthouse and Bracklet to measure everything that spews out of a building and try to reduce that. The second piece, and kind of we say it's a three-legged stool, and we think this is extraordinarily important, is the social piece. And it's hard to quantify, and we get a lot of questions about how you quantify. We've done everything from opening up our conference rooms at our office buildings to high school kids to have access to free Wi-Fi, to doing food drives. But really, when people say that's a little foofy, and I said, well, what we're trying to do is create a community. And the community is what drives this. If you have a community of a diverse people, you really can have an impact. We've partnered with a group now called GiveWith that is trying to quantify this for us. But when you look at the overall, you really want to know, and for us, it's just something this simple that I say all the time. It's like, an office building, an industrial building, they shouldn't kill you. You should know the quality of the air, the light, the water. And when you provide that, and I think that's what we found out of COVID, why our Class A buildings have maintained its occupancy and tenancy very well, is that we have apps where someone can look down and see exactly what the air quality is. They can know that they can go to an elevator and not have to touch something. We have building-wide apps now through OpenPath where you really don't even have to take your phone out of your pocket to open a door for the elevator to know you're there. So when you start talking about what is impact and what is ESG, it's these bigger things that at the end of the day, and the third leg of the stool is your operating expenses are going to be less. And you're creating value, by creating a desirable place to be, place where people feel healthy and safe to be, and your operating expenses are less. And if you do that, I think there's a whole lot of investors out there who want a part of that. We, the part that gets hard is the G part, the governance. And so we fall back on the fact that our company is 55% women, 46% women, 54% men, but it's 55% minority and 45% white. We try to have a lot of diversity. We have everything from impact task force to our technology task force. And so we try to hit the governance on just being an example to other companies of, I grew up in a business that, quite frankly, was white male, and that's what it was. And I saw in the 2000s and 2010, when we bought Pac Mutual, there was a 10,000 square foot sublease tenant who was going to 60,000. And when we were buying this building, we had it under contract. We hadn't gone hard. I went to see her, and I showed up in my Cushman outfit, which was a white shirt, navy blue suit, red tie, and a pocket square. And literally, I walked in, and she goes, "Get out of here." I'm like, "Oh, I'm sorry. I'm here to talk about your lease." And she says to me, "I don't meet with white guys in suits." And I was like, "Oh, wow. Okay. Can I come back tomorrow?" And I came back in jeans and a t-shirt the next day. And I think her point, to me, which I took very seriously, was, hey, I got to find a building and be in a building that reflects my company and my culture. And it's really important to me that you take the time, and I see that your company reflects it. And so we took that to heart. And so you put all that together, that's impact, that's ESG. I can't tell you the amount of times I have partners like Lionstone based out of Houston and some other people in Dallas. I would come and talk about this stuff and I get eye rolls. And now people keep calling me back and saying, "Well, can you talk a little bit more about what you're doing?" And we've trademarked a scorecard for every deal that we do. And that scorecard is something that we give all our investors so they can see from the day we buy a building to when we sell it, and on an annual basis, the audit of these things, the ESG and the impact.
And so is that something that you're just making a decision to do because you're the owner of the company, or do you have investors? Because a lot of folks I know that take institutional capital from pension funds and a lot of these nonprofits, it's almost a requirement. You can't have my capital without checking the box. So is this something that you're...
Yeah, that's a newer thing. That's okay. Newer. No, I mean, we led out front because I was looking for ways to different. Well, number one, I believe in this stuff. I mean, I really do. Just spent any time in California over the last 15 years, man, it's just getting hotter and hotter. And you see that in the Pacific Northwest. So it's not a political statement. I just feel like there is definitely a change in climate happening. Number two, we didn't control kind of the retail pension fund. That's Blackstone's world. I couldn't get in front of them unless I had something that was a little bit different. And now that we've built a brand around it, I guess it's a little tough sometimes to see that Kilroy has, this great ESG officer and everybody has all this stuff, because I'm like, we were doing that 10 years ago. But I also think that's the end result we wanted. We want to create great places and make the world better in doing so. And I think as more and more people do this, and I tell people all the time, I know we get lost and, well, solar is going to cost millions of dollars, or we replace, a backup generator with batteries, millions of dollars. But the prices have all come down because there's more and more demand for this. And I'll tell you, you're not going to get Google if you're doing office or industrial. You're not going to get Google, Amazon, Apple, any of the credit-worthy tenants if you're not thinking about these things and doing these things. They won't even put you on a list for a tour. And that's just where the world's going, and I think is already at right now.
Yeah, no, I mean, and I think in your neck of the woods, it seems like it's probably further advanced than in a market like Texas. But it's certainly ESG. It seems like it comes up every single day. It's cool to hear that you've been leading the charge in that. And you just said something that I've been in real estate 14 or 17 years now and had no idea, and I wouldn't have thought this. But you said office properties and big commercial real estate's the biggest emitter of carbon into the atmosphere. Can you just maybe dive a little deeper into why that is and what about buildings makes that happen?
Well, first of all, just look at the globe and just look at the amount of commercial buildings. So when I say commercial, I'm not talking residential. I'm talking office and industrial or strip malls or pure retail malls. So you go around the globe and that is everywhere. Then you look at the fact that they have to power for maximum use, not minimum use, right? So you go into a retail establishment, you're just not okay if you walk in and it's dark because they have the sensors on it. You just don't feel safe. So they're always powering for the maximum instead of the minimum. And then you look at what the uses, where that power comes from. Most of it's coal. Some of it's moved over to natural gas. So when you put all that together, you can see why it emits 40%. I think airlines are second, or cruise ships and industrial ships are second, and they vie with commercial. But those are the biggest emitters of carbon by those two groups by far.
And so what is like the low hanging fruit that you'll do when you go into a building that can change that?
Well, in California, was something called Title 12, which in 2012 blew my TI budget by about $10 because nobody understood what was. We all got it. Like, hey, if you're going to redo a space with TIs, you got to put in the LED lights and you got to put in the sensors so things turn off. What we weren't ready for was how building departments were going to interpret. If you're doing one suite over here, that meant you had to do the whole floor. And then how contractors realized, well, a lot more people are working now doing this. So it was really significantly more expensive 10 years ago to do a lot of these changes. Over the 10 years in states like, or in places like California, San Francisco, LA, but even places like Austin, you have to do this in Austin, Texas as well. These things are now so in the system that the costs aren't as big as they used to be. Where people really get hit is on trying to upgrade their HVAC systems to be more efficient. If you do some sort of big project on solar or big project on generator batteries. But the TI stuff is kind of blended in. But I'll tell you, my dad loves to talk about the fact that when they did Library Tower, US Bank Tower, he was signing leases at $44 triple net, which is higher than you can sign them today. Operating expenses back then were somewhere between $6 and $8. So you were keeping a lot more of that rent. And today, operating expenses are somewhere between 14 and 18, and you were doing TI deals back then at $20 a square foot, and we're doing them for 100 to 120. So clearly the inflation has come into all of this stuff. And I don't think that's going away.
All right, two more questions before we dive more into the larger business itself. But you said Google and Amazon and the big boys, when they're going to lease, so when they approach you, is one of their first questions like, do you meet these criteria? And if not, they're like, okay, we're not even going to waste any more time talking to you about leasing your building. Like how quickly does that come up for them?
Well, I would say two things to answer your question. Number one, when I worked for John Cushman, it was pretty clear. He was representing a big law firm, a big accounting firm, a big oil firm. It was John and the CEO making a decision. And I could tell you, going back to the late 90s and 2000s, a headquarters was going near the CEO's home, town club, or country club. Those were the three options. Today, when we do a tour, it's not one person. It's usually a committee of 4 or 5 people on HR. It's usually as diverse as the rainbow. Everybody's different. And so you're selling to a much different audience. So that's just kind of like who do I have show up, and how does it force me to have a team that is representative of society and of their company. The second piece is the checklist. The checklist now becomes so detailed. And usually you're dealing with a broker, so I'm dealing with a CB or a Colliers or a Savills or somebody. And before they even put us on a list, that RFP is taking, it's a 20-page answer these questions to see if you even qualify. Which I think not concerns me, but I think it's just evolution. There's a whole lot of buildings between New York and Seattle and California and Texas that are just going to be functionally obsolete for this new world we're in because people don't have the capital to upgrade them to be able to get major tenants. And if Google's doing it today, the vendor for Google's doing it in a year or two, and then the vendor for that vendor's doing it, and then you're just in a society where there's just, I say it a lot. I think the one thing out of the pandemic, I think we're going to see is just kind of like after World War II, where we had this big push in new technology, and there was a lot of obsolescence from 45 to 55, and buildings just kind of died, and there's pictures of all the blight because they just didn't keep up. I think we're going to see that with a lot of office. I think there's going to be a wave of converting non-competitive office into multifamily. I think it's going to be very painful for a lot of generational families who thought they, could always just renew somebody without TIs. People wouldn't move. I think the pandemic's going to make people rethink their real estate in a big way and because they got to attract the talent.
I could be wrong about this, but I read something that Biden kind of made a statement that like by a certain date, all government facilities had to be LEED certified or had to be green buildings. Is that accurate?
Yeah. It's true. It started in the Obama administration. Obviously, under Trump, it kind of got hidden in a drawer somewhere. But no, it's back. And the Obama administration pushed hard. I want to give credit to George Bush, and the Bush administration was very big around these things as well. There wasn't an administration of climate deniers there. But I think it started with Obama, and it's very clear that whether it's LEED or Fitwell, you name the standards, there are heightened standards. And I think back to when I clerked for a federal judge in this building in downtown LA, and he died of a lung issue that I'm convinced was 25 years of breathing the air of a federal building in downtown Los Angeles that caused the lung fibrosis. And so a lot of these office buildings that that the federal government owns, they're going to go through big upgrades, and Biden's pushing it as part of the infrastructure. So yeah, very true.
All right. So so 2011, you merged with your dad. So now give me a picture of the company. What are y'all investing in? I know you have 5 million square feet of Class A office. I definitely want to talk about what you've seen there over the last year. So maybe let's just start there. And then I want to know what else y'all are working on.
Yeah, I'd love to tell you. And I want to go through a few things too. I'm going to ask you a few questions too, because I'm impressed with what you've built. Let me just start with office. So what we found is there's a real value in having credit tenants. So in the first month, every law firm we had in Class A office buildings thought they had some inventive way how they didn't have to pay their rent. And if I had one more person say, well, there's a force majeure clause, I say, yes. And if you read in it, it says, well, there may be force majeure, you still have to pay your rent. So where we've really gotten hurt has been these moratoriums on the smaller tenants. So the small accountant, you name the business, medical billing. I mean, there's all these little businesses out there and some of the non-Class A stuff we own. And we were surprised because with PPP, we really thought we'd get 2 big chunks of checks. And clearly, there's just a group of people out there who don't think they have to pay. And there's nothing we could do. We had a building that's gone from 85% lease down to 30% lease. And people are still have their stuff in there and I can't evict them. And that's not the way the system's supposed to work. So that's to me where I think the government intentionally or unintentionally have chosen landlords as the losers in all of this.
And that's an LA thing because that wasn't federal. Is that like LA based?
Well, this is county and state of California. Okay. The state just went from June 30th to September 30th on a moratorium on all evictions. Now, there's things in place about having to pay back rent, and we're looking at those programs. But there was a disparity that we didn't expect. I actually thought the smaller person with the PPP wouldn't miss a rent check. Didn't happen that way. What we're seeing right now across our portfolio from Class A we own in Denver to Los Angeles is occupancy has now gone from about 10 or 15% 6 months ago to 20, 25% about a month and a half ago. And we're seeing a big push up to 40, 50%. One of the things that we weren't prepared for, and I don't know how you could ever buy a property if you were prepared for it, is parking revenue is a huge thing in an office building. I mean, it can be 10, 15% of your overall NOI when it's said and done. You go 18 months with no parking revenue and, we're going to be fine, but it's painful. It's not fun. And so we have one situation, one of our buildings where we're yielding well over 6%, but we're below 6.7. So that puts us in a cash trap. And you're just going, wait a sec, we're nowhere close to defaulting, not even close at all, but we don't get to control our own money until parking revenue comes back. As soon as parking comes back. So there is a value when you're an owner of getting these must-takes and forcing people to pay, because the first thing that tenants did was cut their parking. Having said all of that, I think what we're finding is most businesses are apprentice-based, mentor-based businesses, law firms, real estate, architectural. So while Zoom and all of that is something that people can do, there's a big push to come back to the office. And now I think, I read about Apple and 2,500 employees send Tim Cook a note saying, we don't want to go back to the best office environment in the globe, and we think you're a terrible person for forcing us. Look, I don't know how you deal with people who have that point of view. Maybe they shouldn't have been in an office in the first place. But I know when I was young, I learned by sitting in a room listening to John Cushman be on a phone, or Mike Meyer, who was the attorney I worked for, or my father, he was a former chairman of the Federal Reserve in San Francisco. You sit there and you listen to that guy have a conversation where he never loses his temper, listens to everybody. You're not going to get that on Zoom. And I think, if you're 25 or 28, how do you think you're going to get a promotion? How's somebody going to see that you hustle? So I think maybe there's this push. If you're an engineer, if you're GitHub who's moved to total work from home, there are businesses out there that work. I will tell you, I don't know if you've had this. It's opened our eyes to the ability to get analysts at a reduced rate from India and other parts of the world. Doesn't mean we don't have analysts in-house, but before you hire that next analyst, we found these interim solutions we never would have found before. So I think that's a reality that we're going to deal with. But I think it's kind of a trade-off. WeWork was making everybody smaller and denser. Now people don't want to be smaller and denser, so they'll have bigger space, but maybe we'll just have less people in it. But office isn't going away.
It's not going away. I'm on your team there. The idea of college kids coming out of college and spending their first day on a Zoom call and trying to learn and get mentored and grow doesn't make sense to me. And truthfully, and I don't mean this as some people could take this the wrong way, but executives want to be in the office. The CEO is going to be in the office, and you want to be in the room, like you said. You wanted to be with John. And over time, I think we're in this short window where there's still this confusion, but FOMO is real. And I think as people start missing promotions and missing great opportunities because they weren't in the room, I think it'll naturally kind of sort itself out. But I am a big proponent of the office. We've been in the office, and I'm assuming the obvious question to you is you probably were in the office sooner than most, and it's probably benefited your business.
Yep. Yeah, I mean, unfortunately, I've got to get on an airplane and go to Vegas in an hour or two to go look at a property. But so I'm not in the office at this moment, so you don't see the background. But we've been, here's the way I look at it. It's almost offensive in some regards when you think about the most highly educated people are the ones saying, no, I don't want to go to the office. Whereas our engineers, our janitors, our property managers, they haven't taken a day off. They've been in the whole time because the buildings have to operate. And so to me, I'm just like, there's something askew in our society when that's the case. But the second part, maybe this is a little more upbeat, is I know I didn't get married till I was 33, 34. And my whole social life from 21 to 33, 34 were the people I worked with and the many different jobs I had. And I liked going to a place like an office and then having dinner down and working out and making new friends. And you don't get that in an apartment. So, I just think between the people who didn't have a choice and have worked through, and then this FOMO and the social life, that office is going to come roaring back. And there are reasons why cities pre-COVID were where everyone wanted to be. We've already seen, I don't know if you've seen it because Dallas didn't shut down, Fort Worth didn't shut down as much, but just in the last month, you're seeing the homeless population edge back as more and more people come back. It doesn't mean we don't have to deal with those issues, but as more people come back, you're seeing that energy again. So
it's going to come.
We feel good about it.
Yeah, no, I feel great about it. So are you looking at investing in more office right now? Or are you just trying to maintain what you have? Like, what's your kind of 10-year look on office and what y'all will be doing there?
Well, office is still a big thing. We're about to go under contract to buy a major Class A office building in San Jose. I would say that where our focus has turned is much more to the creditworthiness of the cash flow streams than the opportunity to lease new space. So we're looking at more core plus and seeing if we can bring our impact strategies to create value around a core plus deal. I don't think we know exactly yet. I don't think the law firms have figured out exactly how big they're going to be. So I would say a value add office play, unless it was like from the ground up value add, kind of an opportunistic play. I don't think we're going to be buying 60% leased buildings in the next 12 to 24 months and hope we have a good leasing plan. I think we're more likely to buy 80, this one in San Jose is 3 tenants, 3 income streams, buying with a Korean pension fund, We're going to bring our ESG and we're going to manage that. So we think buying those kind of, I don't want to say pure triple net, but fewer tenants, quality income stream is a good thing. We also have dipped our toes into the crowdfunding in a way. I early on invested in Fundrise. I happen to know Ben Miller and watched that, and I watched them evolve from trying to do one deal at a time to now creating these e-REITs, which is a good business model, and I'm happy with the investment. But I actually think out of the pandemic that going directly to the investor via Realty Mogul or CrowdStreet is the future that we want to play in. And we went live yesterday on our first ever this industrial deal in Las Vegas that I want to go back out and see for about the fifth time because now we're live and I got to do a webinar on it. And we're getting unbelievable interest, I think, because I think there's a whole group of investors who want to put in 30, 50, 100 and get a real cash on cash return. So we think office will play into that if we can find smaller office deals, looking for equity checks somewhere between $5 and $8 million, and whether that's office, industrial, or multifamily. And I'm a big believer in it. There is not a real estate company out there that I've seen, Hines, Lincoln, you name the big developers who's put their name behind it. I mean, they've all done the non-traded private REITs. You know, they go to the Merrill Lynch broker and get the $10,000 investment, but nobody's really put their brand behind doing crowdfunding deals. And I think Robinhood has changed that. I mean, people want to be able to look at their phone and go, I need more than 1% or 0.05% interest in a checking account. I want something that's going to throw off 9% a year and, on a 3-year hold. And so we're spending a lot of time, and office will be a big piece of that, we think.
Man, we see a lot of the world the same way. I couldn't agree more. I think I think we're through that phase of crowdfunding being kind of like not a joke, but everybody's wondering, is this real? No great operator would actually go get crowdfunding. And what you're seeing now with your company and lots of brand names are starting to raise money through that model. We're syndicators, so we raise from over 700 people. And I think the democratization of capital is underway, and the old way of raising money from one big group is going to continue to kind of decline, and there's going to be a lot more competition. So I'm with you there. I was going to ask you how you raise capital. You kind of just answered it. You had a Korea pension fund on one, but you're doing crowdfunding on the other. So is everything deal by deal?
Yeah, right now, I mean, the fund went poof, which, we kind of fell in love with the income stream before we had it. So we learned the hard way on that. We started to ramp up and we're like, oops, that went away. But for us, the way I look at it, I mean, I find, I mean this honestly, Chris, you guys are an inspiration. The Keith Wasserman at Gelt, you guys are a real inspiration. I had the guy who runs Christina Development LA come on my podcast and talking about how the Jobs Act has just obliterated the things that we used to do. Like my first PPM I ever did, I did it with Michael Barker. We raised a small fund, and I remember we had 100 PPMs done. I started the numbers handwritten in 061 and then numbered it from there. And the rules were back then, you sent out a PPM to somebody if they said no, you had to get it back. And then if the IRS came, you had to show them, I got all of these back. That world is blowing up, and the syndication online. We have the Rising Investment Platform, which is for accredited investors who want to be in co-GP or heightened LP position. And then we're using that. Those are people we know we can trust, who will fund, we've vetted them. And then we're using the crowdfunding on the LP. And we have we just bought something in El Monte here, which is a government lease that we bought with a group called Brasa. So we still do the private equity where we're 90-10, 95-5. And we're going to continue to do that. But I think there's this right now, and maybe you tell me if I'm wrong, if I'm missing it, but I think there's somewhere around 5 million to 7 to 8 million that you can raise consistently on a cash flowing deal with less risk from these crowdfunding sites.
100%.
And since we've built, just like you've built, the operation that can operate these things, that bring our brand to it, that bring our ESG strategies, impact strategies. And I just see a real window there. And that 7 to 8 million is going to become 15 million before you know it. And so it'll be interesting to see how it evolves. But I kick myself because I've tried to be early in these things, and I invested in Fundrise early. But early on, when I talked to CrowdStreet and I talked to Realty Mogul, I was like, well, I don't want to be non-refundable on something and not know if I have my LP capital there.
Yeah.
And, so we've gotten past that, and we realize that, you do have to have your LP capital as a backup plan. But this has gone very well so far, our Cheyenne Airport deal, and I think we're going to do a lot more of them.
I love it. No, I'm with you. We can raise now anywhere from call it 5 to 10 million in a matter of hours. And I've told our team, we have 700 now. We need to be at 7,000 investors in 5 years. There's no reason to not keep accumulating and meeting great people. And I think, like you said, even the big boys are starting to do it.
Well, I'll tell you an interesting story. So we own a deal with Colony Capital, which has now become Digital Colony. And so I was talking with Mark Angie, who's led their switch from traditional real estate to the digital real estate, the data centers and all. And he said he raised $6 billion during COVID from international sovereign wealth and all that. And what's relevant to our discussion, I think we'd both like to raise that. But he said, it was this simple. We used technology. We put GoPros on our engineers. We tried to stage everything via video as though they were sitting in our conference room, or we were walking them through our data centers. And I think it's that innovation on how you can raise capital that now we can get away from this paternalistic thing. If you're not an accredited investor, you really can't risk your own money. So we've gotten rid of that. And now it's going to be what brands sell best to people. And also, it really comes down to the deal, right? I mean, if you really get my father in here and say, what's the one thing you can learn about real estate? You can never get away from a bad basis. And he will say that over and over again. So I tell my team, we do buy things from brokers, but we never want to admit it, because that just meant that we were willing to pay the most. We got to have some angle why we really weren't the most. And so having all the money to invest is great, but you still got to find the good deals, and you have to execute on the business plans.
For sure. And like, if you have there's way more capital in the world chasing deals than there are deals. And so if you have a deal, money will find it quickly, especially if you have a track record. One thing I wanted to ask, I know you have a couple questions for me, but I was going through your vertically integrated, and maybe we talked about it through what you do with ESG, but one of your services is experience optimization services, which I've never seen before. What is that?
Well, I'll say two things. It's one goes to our property management experience, but it's what happens when you're in a pandemic and you say to people, we need good ideas. And we had a team meeting. We operate off of something called Traction, a book called Traction by Gino Wickman, but we operate on EOS, which is our operating system for how we run our company, from the 3-year plan to the 1-year plan. So we were having a quarterly meeting right around at the end of March of 2020. And we just said, guys, we need some good ideas. How are you going to get people to come back to the office? And we had 3 or 4 of our property managers spend a bunch of time saying, what would be the optimal experience to bring people back? And we started talking to the Genslers of the world. And so if you go to OneCal, you'll see that. But then we said, why don't we offer this as a service and third party? And so that's what we've started doing. So that's what it is. It's really just saying, how do you get it from the moment somebody drives their car and parks it either on a surface lot or in a parking garage, to they go to their office, they spend the day at the office, to when they get back in their car and they leave? How do you enhance that? How do you make people feel safe? And so that's what it is. It's a part of our property management. It's not a separate fee that we charge, though we have done that for just some consulting. It's just part of our overall property management experience.
I love it.
But it's not me. It's not my partner, Scott. My dad's about 80 and is deserved a rest. So one of my best friends from a guy I went to college with at Duke, Scott McMullen, who opened HFF in LA in the 90s, and we were friends through it all. And then he was there when they went public. And then he's partners, owns a marina business, but he bought into our business just pre-COVID. And we were sitting there saying, how are 2 guys who really only know certain things about real estate going to solve for this pandemic? And we let the team loose. And that's one of the great things when you see people engaged and excited. And I mean, our property managers, I really can tell you, they care. We have bonuses within the company for executing on business plans. They don't have that if you've hired JLL to do it or CB to do it. And I just know they care more because we see it. I mean, all this ESG, our scorecard is all a product of our property managers just meeting with consultants and coming up with better ideas to give people information and to have a better experience. So, great team.
Me and my partner, we often say like those first 3 or 4 months of COVID, the amount of energy and creativity and just being able to refocus on the business was incredible. And you might not ever get that time back again, where you're such against the wall, kind of in this new situation that you're just forced to keep thinking smarter and keep thinking better. And then, as things kind of loosened back up and we kind of had a path, not that we got by any means lazy, but that freaking unbelievable focus just kind of goes back to, day-to-day things. So cool to hear y'all came up with that. We did something similar. And I just remember how hard those first few months, how much the creative juices were flowing.
Yeah. So I got a couple of questions for you. Can I ask you a couple?
Yeah.
Okay. Well, one of the things I find most impressive is I have paid attention to your group of investors and how you communicate, but also your willingness to take risks. I heard one of your podcasts, you did construction management once, or you were a contractor once. You said, that's not for me. But you've grown. But what I want to know from you, what was like the one pivot moment early on where you said, I have the stomach for this?
For real estate?
Because to be a print, yeah. I don't know if everybody understands when you're signing guarantees, or, we try not to sign those, but we still have to sign non-recourse guarantees. What was it that happened for you that you said, I can do this. I like this. I'm okay with it. Because a lot of people run for the corner when some of these tough economic things hit.
Yeah. That's a really good question. I think, and I'll try and answer it. I think one of it is, I think some people are just born more risk takers than others. There's personality testing. It's very scientific based. So any personality I've ever taken would say he's a bigger risk taker. And risk doesn't mean bad, like a bad risk taker, but it's always come natural to me. Second, you read all these books, these great people that have done great things in the world. And one thing they all share in common is they're risk takers by all definition. And I always just kind of identified that in order to kind of achieve the goals I wanted to achieve, it was just going to be part of what I wanted to do. You've never met anybody, Elon Musk is not Elon Musk without taking risk takers. I'm not saying that's who I want to be, but it kind of comes with the position. But more than anything is what's risky to you might not be risky to me. So an example that would be, everybody thinks Bitcoin is risky, except for the people that have been in Bitcoin for 10 years and understand it to its most fundamental level. I might say, I think LA is a risky place to invest. And you're sitting here going, no, it's not. And you've been there 15 years. And so what you often find is consensus upon what risk is usually people that don't have in-depth knowledge of what they're saying is risky. So everything seems risky that you don't know anything about. And what I really learned was the people that made risk look easier were actually just unbelievably hyper-focused on a few things and were really good at them, and they knew where all the risks were. And so one pivotal moment for me along the way was there was a point where we were a jack of all trades, master of none. We were doing all these different kinds of deals. We were developing townhomes and buying existing apartments and developing land, and they all felt more risky. And that wasn't because it was because we weren't that good at any of them in hindsight. We were making money and returns, but the more focused we got on fewer things, the less risk felt like this thing that we had to think about all the time. Not that we're not trying to cover our ass and we underwrite and we make sure we're making the best decisions, but risk fades away the more you get to know about something. And so just maybe a pivotal moment was realizing that I didn't feel like things were as risky the more I got to know them. I knew what a good deal was and a bad deal. I knew all the 5 million things that could go wrong that you just can never know if you're just shooting with a shotgun instead of a rifle. So maybe that's a way to answer your question. Was I was kind of born with it. I realized that it was going to be part of my gig. It was just kind of where I wanted to be. But really, the more you focus on something, the less risky it feels.
Yep. I think, and the other thing I'd point on what you said, which we agree with wholeheartedly, is, flying used to be a lot more dangerous 100 years ago because people hadn't made all the mistakes and the technology hadn't improved, but they started with standard operating procedures. As soon as our business got to that point after the first buying the first building where we started keeping lists, the risk felt like it was starting to lessen because we, like you said, you make 100 mistakes the first deal. You try to make 100 different mistakes on the next deal, and then as you go. So that to me, that's a really good answer. It shows you've got the battle scars.
Oh, I've got a lot.
Yeah. Then let me ask you this. What I've also been impressed with you about is your use of technology and the way you've been able to put together your investor group. Was that something that just because you're a little bit younger than I am, that technology was just a part of what you did, or was it a strategic decision from the beginning to be like, hey, man, we're not going to use paper. We're going to communicate with our people this way? At what point did technology become the force multiplier that it looks like from the outside looking in, that you guys, the way you all use it?
So it's a great question. I'll answer it in two parts. One, I kind of fell into real estate. I started buying real estate in college. I graduated in '08 when it was just no jobs available. But I always tell people if that hadn't happened, I probably would have moved to Silicon Valley and gotten into tech. It's just always been something that interests me. But given that I'm in real estate and just watching great businesses and seeing what was propelling them, technology was a huge part of that. And it was reducing costs. It was making them move quicker. It was helping them make better decisions. I mean, it was ultimately a net positive to the businesses that did the best. And then I would look at companies that, would say, well, we don't want to use technology, or they didn't have a team that knew how to adopt it. And they have way more people on staff. They're doing way more redundant things. I mean, there's still companies out there that are writing handwritten checks and sending them to investors. That just seems crazy to me, when we can click a button and send distributions to 700 people, relatively quickly. And so I think if you have one great experience with software in a company and you see cost dramatically decline and efficiency immediately go up, it just becomes a filter that you can start looking at everything through. And for me, it was important. I think, again, that's part of the generation I'm in. It'd be a lot harder for a 80-year-old boomer to really believe in technology the way I could, because I was born into it. So I think a lot of it's a byproduct of our generation. It's just always been really important and always made a lot of sense.
Do you have kids?
Yeah, 4-year-old and a 2-year-old.
Okay, so I've got a little bit older too. So I've got two 16-year-olds and an 11-year-old, almost 12. I am amazed at the economy that is out there that I never see, from them buying V-Blocks and buying all these things. So there's this whole digital economy that most people in real estate don't even know exists, and it's coming to real estate. And if you're not ready for it, you're going to be able to sell things via your website and things that'll drive NOI that people haven't thought about. And I think it all starts with exactly what you said. You're just comfortable with technology, and it puts you in a place where you see it. And so I was just really impressed with the way you guys use technology. But let me ask you this. When you started the company, did you go Google or did you go Microsoft?
I went Microsoft, and we're still on Microsoft. Fortunately and unfortunately.
Well, that's pretty smart today, because Teams is a pretty good product. It's better than Google Workspace. But we started Google and haven't left it. But these are pretty definitive decisions on an operating systems that you choose for your business. And how do you maintain discipline? That's my biggest frustration managing people, is we'll bring in someone new who thinks that, well, email's okay, and we are just adherents to Asana, and you don't talk to anybody via email within the company. Every once in a while there'll be something I forward that I kick myself when I do that. But how do you enforce the use of Microsoft Teams and all, and what's the culture around that versus just emailing people?
Yeah, so it's a great question, and I'll start it by just saying, the greatest software in the world is useless if the team that is being told to use it is not bought in. So most of the times when you talk to people, they're like, oh, that software sucks. And what they're really saying is like, we never gave it a chance. Nobody was held accountable to its success. Nobody actually spent the time to get to know it, and therefore we neglected it. And you do that over enough with the team, every new thing you introduce them, they're like, nope, we don't want to do it. It's going to suck. And so I guess I'm starting with, the culture that you create to adopt and use technology matters far more than the technology itself. And so to your question of like, how do we hold people accountable is, one, if we're going to bring on something new or we're going to do something, the leadership team has to be bought in. So if it's just the CEO always coming in saying like, hey, my buddy's company uses this and we're going to use it, and nobody's had a chance to buy in, you're starting from a tough situation. Once you get that, we call them power users. But one, we give our team like a year to adopt the technology. I think a lot of people think if it's not up and running in the first month, it's a failure. No, people's habits have to change and you have to give them grace to learn it. But really it becomes, there's certain people on the team that are accountable to its success. So if it's not working, then it's somebody's not doing their job right. We do a lot of training. And to your point of, our software is our process. How they all work together is like, you can't function in our company unless you're working on them. And so if there's somebody that is trying to send emails internally or work outside of the system, it's flagged immediately, and most of the people the system breaks down. And so, just like all culture is what you're willing to accept, is there is no easy answer, but it is the leadership has to constantly pound the drum and let them know that it's important to them. People that use it appropriately need to be praised in front of the team, and people that aren't using it appropriately need to know they're not and be given kind of general instructions. But you're always working on it, because software you don't have a process and then software here on the side. It's all part of the process. And so you're either following it or you're not. And if you're not going to follow our process and you're going to be a repeat offender, maybe you just should go work somewhere else.
I say that a lot. I say, if you worked at IBM, you worked at Blackstone, are you going to be the guy or the woman who says, no, I'm just going to email that?
Yeah.
What are you going to do next? Like dictate a memo and type it out? I mean, you use what you have, but it's amazing. It's obviously we're kind of subtly talking about people who are older and more mature in the business, because I don't really have trouble with people who are younger. And they tend to teach me a few things around it. But I just don't know how you can run a business today and not have software be what drives it. And but having said all that, I think it's got to be a force multiplier. It's not the force. The force is the creativity. The force is the interaction, the teamwork, people relying on each other, and then technology multiplies that.
Correct. Technology is supposed to give people more time back to be creative and do other things outside of the software. That's what it's really meant for. It's not meant to consume your whole life. It's meant to give you your life back to be good at what you're good at. And so, and candidly, and we don't have this on our team. I think the oldest person on our team is 45 years old. But look, it's a real issue. There's all these boomer businesses filled with 60, 70, 80-year-old people that it's just silly to think they're ever really going to give a shit about it. They just didn't grow up that way. They lived most of their life without it. And then all of a sudden, 20 years later, you have these kids that are given an iPhone at 5 years old. I mean, my 4-year-old daughter can do more on an iPad than I can. And that's just different. And I don't know how to solve that, but it just is what it is.
Well, I think what it says is you got to constantly be willing to learn new software. I think there's no end. It's not like I have it down and Microsoft is just going to stop doing updates. I mean, you got to keep doing it. And I think this is the reality when you talk about operating properties, is your team has to be willing to continue to learn new software, new hardware, because these buildings, whether it's an industrial building or an apartment building, an office building, they're only going to continue to use technology in a way that you come along for the ride or you don't. And I think there's going to be something, we haven't really talked about this, but opportunities out there. I think buying retiring boomer portfolios is going to be a real opportunity over the next few years. We haven't quite gotten there yet, but we're starting to, where people are like, man, I haven't, people still sign in on a binder when they come in. I mean, find me about 15 of those properties. That's what I'm looking for.
Well, we've been buying Class B industrial properties for the last 5 years. And traditionally, they've been owned by, you might have the electrician that had a big electrical distribution business back in the 80s, and he built a business park around it. And, he's older and not institutionalized, and certainly not a professional real estate owner. And traditionally, a lot of the Class B assets that we have bought have been from sellers just like you're describing, paper ledgers, one guy in a truck, those type of things. And there's just, when we see that, we're like dollar signs and stars go in our eyes, is there's just so much opportunity to improve. And what you find is, it's not just the landlords. When a landlord's operating that, it fatigues the tenants too. We go in and we get the tenants to set up online pay. We give them a portal to give maintenance requests, and you just see their eyes light up too. And so it's coming from two ways. I feel you there.
So I got to ask, because you're a native Texan, aren't you? Are you born and raised in Texas?
Yeah.
So how do you all feel about the mass of Californians moving to Texas? I mean, Austin is become quite similar to parts of California. How are you guys dealing? I don't mean just really Californians, but what do you see about population growth, and what do you think about Texas over the next few years as a place to invest?
Oh, Texas. I mean, again, I live here, so everybody listening, this is not investment advice, but the truth is the numbers are real. We've averaged 400,000 people a year moving here for the previous decade. We're hearing 800,000 to 1 million. The wave of Californians is great. I think there's, this is not a political statement. We just hope they come with more maybe of a moderate view of the world than the problems that they might be leaving in California. And I was actually talking to a buddy the other day that's moving from LA to Austin. And he just said that, the data he was reading was saying that. So Texas is a special place. People are coming here for a reason. And I just hope we're able to withhold that from people coming from the coasts where, they might be leaving something that they didn't like. I don't know if I'm answering your question.
No, you are. What's interesting, having lived in California all my life and watched, Coto de Casa, and my father just retired from the Irvine Board Ranch, was on the Irvine board for 15 years. But the California of the 80s and 90s, very different than the California today. And a lot of that's driven by the just number of people that have moved here over the years. When you have to provide services to 40 million people, as opposed to 15 or 20 million, it changes a lot of things. And so it'll be interesting to see how Texas grapples with the fact that the roads are just going to be more and more busy, and there's not a whole lot of public transportation, and schools become more. And, California, we have Prop 13, which was a result of the 1970s. People just fed up with property taxes just going up and down and going up, up, up. And you don't have anything like that in Texas. So property taxes are reassessed every 3 years, whereas in California, they can only go up no more than 2% every year. So there are challenges. I mean, we're long Texas. We had 2 deals under contract in South Texas that we split the bid on because we found some due diligence, and they had 3 buyers lined up behind us. So they said, "All right, we don't want to change our price. We'll go to somewhere else." And my partner Scott is born and raised in between Dallas and Houston, so. We plan to put a flag down there. We're disappointed we haven't yet, but I'm a big fan of Texas. Have been for a long time. I think it'll be interesting to see how Austin grows. I think that'll be a real interesting thing. But I think Dallas is, if I had to invest anywhere, I'd go to Dallas or Fort Worth right now.
You're asking the wrong guy, but I think DFW has the makings and the fundamentals of being one of the most important places in the world over the next 25 years.
I'll tell you I know we're going long on time, but I want to tell you an interesting story. So I was able to represent with John Cushman Boeing, and Boeing was leaving Seattle. They were going to move their headquarters, and we headed down to 3 cities: Chicago, Denver, and Dallas. And we were getting courted by everybody, and Boeing eventually decided that they would go to Chicago. And when we went back and did a debrief with the Dallas folks, they said, what was the decision? And John said, to be very honest, they felt there was more culture in Chicago. There was opera, there was museums. And this is what I love about Texas and people from Dallas. I said, okay, we'll take that, and we're going to solve it. And if you look at it, in the last 20 years, all the culture that has been built from the museums and the parks, and Dallas took it to heart, and they don't lose headquarters like that anymore. Because, so I always say, that's the way California used to be.
Well, I will say this. I love California. As a visitor, the people that I know there are incredible. I'm a general believer that 99% of the world is normal, and all we hear about is the 1% on the edges that get all the attention. But yes, I mean, look, in Texas, we have border trade. We have a port. We have oil and gas. We have a business-friendly climate. We have great weather except for a couple months of the year. And there's a lot to be said. And But that's the same thing California had for decades and decades and still has. But too much of a good thing can, turn sour. And I just hope we handle it well. And this whole last year,
salt. Getting rid of the salt was a big deal for California and and New York. With your inability to write off your state taxes, I mean, that really put the high tax rate in full focus. So it'll be interested to see. I mean, I have several friends, and I said this. I happen to have grown up with Governor Newsom, known him a long, long time, and I said, so you can't deny that people are moving. I have friends who, they can live here when they're not going to have an event. If they're going to suck out some of their income and pay taxes, they'll do it. But if someone's going to have an event and they're going to make generational changing money, why are you going to live in California and pay and have it suck up 13% more than your partner who lives in Texas or lives in Tennessee? These are real. So if you're going to start a company, you have to ask yourself, outside of the VC money, why California? Why New York? Why Boston? These and Bill, what's his name? Ackman is making a huge bet on real estate in what he calls the no income tax states. So I think it's real, and you can't be a Pollyanna and wish it away. It's a real thing.
It's real, and the data is showing it. I mean, all the cities that are having a population decline the last year are those cities that you just mentioned, and all the cities that are having massive growth are those. And people can, vote with their feet, but now that everything's on the internet and you can actually see it for yourself, I've been telling some of my friends in LA and San Francisco that, I've been wearing a mask for months. And they're like, how could you not do that? And I'm like, dude, you need to leave San Francisco for a week and go to Florida or Texas and just see what's going on there. And then bring that kind of mentality back to where you're at, because I don't know, there's just some places of the world right now where it's just way more polarizing than others. And I don't know.
Yeah, I hear you. Well, it's an interesting world, man. I can't wait to buy you a beer or something when I'm in Dallas next, in the Fort Worth area. I mean, this is great. I know we've been going for a while. I bet you we could go for another 2 hours.
We
could probably keep it.
I know you got to get to Vegas. You have an open invitation next time you're in Texas. I'm a fan of everything you're doing in your podcast, and thank you for joining me today on mine.
Thank you, man. I've been so excited about this, so I'm glad we got to make it happen.